Good evening, everybody. Good morning to some of you, and good afternoon also to some of you. Welcome to this joint live webinar organized by Committee on International Taxation of ICAI and the Muscat chapter of ICAI. The topic for today's session are tax treatment and challenges for Indian investments in Oman, and correlated to that is the tax incentives by the India for the foreign investments and areas to be kept in mind while making investments abroad. Special references to the DTAA between India and Oman. On behalf of the Muscat chapter, I would like to thank the Committee on International Taxation for extending their support and arranging this webinar on a really short notice. And we also thank the panelists who have agreed to share their views and also the moderator to conduct this session. I now request the chairman, ICAI Tax, to address the gathering. Over to you, sir.
Thank you, Chairman. I just say good day to everyone and good night those who are still with us. The effort for the first time we are trying to mix up the Muscat chapter Oman, specifically the taxation piece of the Oman, India, and I think viewers, wherever you are, the request which we have made to the that they will try to answer the question, and still if there are some questions which are not answered or remain unanswered, then we'll try to get their answer by our own internal discussion with the other people and other so this is something Oman is
I think we have lost, sir. So your voice was not clear. If you can repeat it.
Yeah, continue with the session.
Okay, thank you, sir. I request Chairman of Muscat chapter, CA Sajeev, to please address the gathering.
Thank you, Unmeshi. Good evening, everyone. This is Sajeev Surendran, CA from Muscat chapter, chairperson of the Muscat chapter, Oman. Thank you, International Taxation Committee, for coordinating with the ICAI Muscat chapter to have this event. And this event is more relevant, as far as the Oman perspective, because from two perspectives. One is from the people who are the chartered accountants, the senior members who are setting up these days practices in India, and from the business perspective, they represent the organizations in Oman. And this kind of the taxation matters. As you know, the GCC is getting into the tax regime these days. We have Oman, per se, we had a taxation, direct taxation, corporate taxation for last couple of decades, but GCC, UAE is starting from next year. VAT just started last year. So UAE, GCC also is getting into tax regime these days. So it is more relevant to discuss the taxation matters, specifically the 700 chartered accountants in Oman. So we are away from the country for 10 years, 10, 20 years, 30 years. Even there are members who are here for 35 years. So it is very, very relevant to discuss the topic, to have the clarity on the tax treatment between Oman and India. And as far as Oman is concerned, Oman is a beautiful country with a very positive investment and business opportunity locally. It's a single point economy at the moment, which is the oil-based economy, but are the resources, which is the natural resources, the fisheries, minerals, oil, and the tourism are the main sectors which we look at. And the export at the moment, the other exports, it's not that that big, but the oil is the main focal point for us at the moment. And we have around 700 chartered accountants, around 150, not as per the record, but informally around 200 plus members in the practice, and the rest are in the industry. This is actually from Muscat, and thank you once again for having this organizing this session, and I'm sure this will be beneficial for the members both here and in India. Thank you so much. Over to you, Umeshji.
Thank you, CS Ajib. Now, without wasting further time, all are excited to hear the views from our eminent panelists. So I hand over the proceedings to CA Rishabh, who is the moderator. Rishabh, over to you.
Thank you, sir. So I will quickly introduce our speakers for today so that we can then jump up to the technical session. So we have 3 speakers today. So PV Srinivasan sir is a corporate advisor on global tax and corporate laws. He has been head of corporate tax in Wipro for 18 years, and he has more than 33 years on hands-on experience in industry with regard to corporate tax and compliance across jurisdictions like US, Europe, India, and Asia Pacific. And he has secured a couple of landmark decisions in courts in India and abroad. Our second speaker from India is PVSS Prasad sir. He's a practicing chartered accountant, and he's in Hyderabad since 1986. He has held various positions of responsibility, like he was the past chairman for the Hyderabad branch of the ICAI, and also the past president for the IFA Hyderabad subchapter. He has co-authored and authored many books related to international taxation, one of which is International Taxation, a Basic Study. And he has spoken, given seminars and webinars on various national and international forums. And our guest speaker from Oman is Mr. Ashish Athawale, and he's a member of Institute of Company Secretaries of India. He has done his Masters in Business Administration with specialization in tax. He was responsible for setup of VAT practices in Oman, and he has also supervised VAT practices in Bahrain and UAE. Welcome to our platform, all the panelists, and we will begin by quick introduction about the topics, starting with Srinivas sir.
Today I want to talk about outward investments into Oman because that is what possibly I can help you on this in this particular session. Oman has to be seen contextually, that today if you have to do an outward investment, what are the destinations you choose? Normally, you may look at Singapore, you may look at some countries in the say UK. Middle East is also gaining ground now. You find that Middle East is a very attractive proposition, and amongst the Middle East countries, Oman also qualifies very well. You find a very attractive corporate tax regime. Personal taxes also are more or less exempt. You find a VAT which is very attractive. The possibility of making an investment which is wholly owned. There is a possibility to incorporate a branch abroad. There is a regulation which will talk about remittances. If you earn money in Oman, whether you are compelled to, is there a capital amount remittability? Those issues are also which require consideration. You find there are withholding tax regimes which are comfortably placed and comparable with many other countries. And you find employee taxes, expat taxations issues which have to be compared from other countries in the Middle East. You find that some of them are very comparable. You find there are international events which are happening, like aligning the global taxation to a regime, the CBCR filing, ability to allocate profits, how do you allocate profits globally. These are the issues which are being debated globally. Oman is integral to these processes in many ways. They are not mandatory. Oman will possibly evolve into these kind of regimes, so you get some kind of a global integration into this. My own personal experience is that there are countries with which you would like to compare Oman with. Not that everything is a matter of comparison. You look at many other factors beyond taxes while going into country. Oman, for one, you will find the Indians have been able to establish businesses and carry on very successfully. So you will find that there's some kind of a substantial presence of Indians already in Oman, and ability to do business in Oman is welcome. Oman welcomes Indian corporates doing business in Oman. There is a reasonable ability to get mobility of people, but there are certain difficulties which I am very sure will get some assistance from the Oman ICAI group. You may think that a foreign holding is one of the interests. Very often when we go to the Gulf countries, we hear that you must have some local partner, otherwise you will not be able to establish businesses. We will hear a little on whether Oman can do away with this requirement of a local partner, and how do you attribute profits. Very often in Gulf kind of environment, your shareholding pattern is different from the profit allocations which you do. You can have a shareholding, say 60-40 with a local partner, but the profit distribution can be 90-10 also in certain countries. So you're able to distort. That kind of regime exists in the Middle East. Possibly we will get some assistance as we speak. I don't want to take all the things which the Oman speaker will speak a little later. Essentially, we want to see how the allocations of profits, is it commensurate with shareholding, or it can be skewed in such a way. I can have a 90-10 for a moment, but can I have a profit sharing of 100 or 99-1 for a moment? These are the things which may require a little amount of consideration while doing it. Important aspect in Gulf or any country for that matter, you may establish a business, you may earn profits. The final bottom line is whether you can repatriate it out of the country. If there is no ease of repatriation, either in the form of a dividend or in terms of return of capital whenever is required, there is going to be some amount of difficulty. And therefore, a preference is whether you can convert it into dollars and remit it, whether there's an ability to remit money out of Oman into any other country at a choice, or there are retentions which are to be made. What are the difficulties in remitting? This is the aspect which I thought is very important. I personally felt that Oman has no retention. This is my understanding of the law. I will be standing corrected. There is no retention. You can remit all your profits, whatever you have, and even a return of capital is possible under the Oman regime upon certain events being, for example, if you liquidate your company, capital will be returned, and there should not be difficulty in liquidation company. All other countries, for example, the Kingdom of Saudi Arabia, if you have paid zakat, then you can repatriate. That means upon paying zakat in Kingdom of Saudi Arabia. Qatar requires a 3% retention till the tax clearance certificate is obtained. Bahrain has no retention, but Bahrain itself is looked at more like a very attractive decision, not that any adverse view. Personally, it looks like it is more on drone business, and therefore we find Bahrain is very good for a tourist kind of a mechanism, but it doesn't really qualify as an investment regime in my limited understanding. Kuwait, many things positive can be said on Kuwait, but my way of, I have traveled to Gulf countries quite a number of times. You find that the cultural integration, when I say cultural integration, they are all Islamic countries in many ways, but ability to adopt to cross cultures, that I think Kuwait may be a little less open compared to Oman and UAE. UAE, of course, we all are very familiar with. There's a seven aggregation as a federation of 7 emirates, and here there's no retention. So on retention, if you look at Oman and UAE would score very well, and they are comparable, and you may find it extraordinarily attractive as far as UAE is concerned. The employees, normally the understanding is that there is no employee taxation in most countries, but that is not the way to look at employee taxation. We have to look at employee taxation in totality. There may be social security costs for which employee may not derive any benefit while he is there, but nevertheless the cost of employment which has to be borne, what the employer contribution, what the employee contribution, is it prohibitive interest between the economies? This is one aspect which we'll always look at it. The international development, the CPR, and the master requirements, they have not been mandatory so far. Oman is easy on the regulations, if I say. So you may have an entity in Oman. Of course, Indian headquartered companies may be compelled to adhere to CBC regulations in India. But as far as Oman headquartered companies are concerned, there's no requirement to file CBCR notification. But there is a notification which has to be done, which I think can be complied with. If I have to, my own sense is VAT regime is very effective in a country. All imports also at reverse charge, much like any other country. There's a 5% VAT which is levied on goods and services, both goods and services, and there is no exclusion whatsoever. There are certain exemptions, but most of our businesses may not qualify for those exemptions. There is a very liberal ability to avail tax credits. You can avail the input tax credit for almost 3 years, unlike some domestic law in India where the ability to avail credit is very restricted. So ability to take credit is almost 3 years, which is very liberal for a tax regime, if I can put it. The remittance is very comfortable, 30 days from the end of quarter. So a VAT regime which is very, very nominal, 5% tax on goods and services compares very well with the most, even Singapore may have a higher goods and services tax than Oman, and certainly it is very well comparable with other Gulf countries. Qatar may be an exception because it may not have a VAT regime at all so far. We have to qualify equally vis-a-vis the ability to do business, how the local administration facilitates you. If you are Qatar, you have to obviously talk about Qatar Financial Center as the qualifying basis for many other things which you require. That means you are narrowing down your scope as to where you can do business in Qatar. In Oman, those restrictions are not there. It is that you can establish business anywhere in Oman and you can still avail all the benefits which I have talked about. If you can, there is a withholding tax. We'll talk about it later at this point. Corporate tax is a very attractive one. I will possibly ask the Oman desk to clarify a little more detail when he speaks about it. I find it's comparable to some of the best regimes. Certainly, it's comparable to even India for a moment. India too has a corporate tax regime for manufacturing companies at 15%. Oman too has a very attractive corporate tax rate. Qatar may score a little better for corporate tax. It levies 10% on foreign ownership. Now, foreign ownership, because there is a local ownership requirement itself that is presentation. So you have to look at each one into a dissected mechanism for ability to the tax. Again, some parts of the corporate tax regime itself is divided in the sense it identifies the profits itself with the owners, final shareholders. So some tax sometimes gets levied only on the foreign ownership and it's not levied on the local ownership. So you find that there is a regime, that is the corporate profits are dissected even at the point of shareholding, subject to tax, and on who the share. The mechanism exists in the Middle East, and Kuwait has a 50% tax rate. The UAE may not have a tax regime at this point in time, where they're actively considering a tax regime. With this, a small brief which I have laid out for you, I will certainly have a little more questions a little later. We can go very deep into each one of these issues. For example, if time permits, I would like to talk about each one of them in greater detail as to how CAT gets levied, how VAT gets levied, what are the comparable regimes in each one of them, why do you choose Oman as compared to other countries. That kind of a comparison will educate all of us to make what is called a very informed decision that if you have to be in Gulf, why do you want to choose Oman over others? That kind of a mechanism is borrowed. Or on putting it in contrary terms, is that any other country within the Middle East, it makes more economic sense for us, and also a social context being kept in mind. I would leave the floor to the next speaker to take it forward. I'll be happy to join at any point in time. if any clarification I need to provide while other speakers are making also, I'll do that.
Thank you, Srinivasan sir, for a wonderful comparative analysis, and you got our brains running already about the GCC countries and their tax infrastructure. And so now I would request Prasad sir to please step up and continue the session ahead.
Thank you, Rishabh. Am I audible? Am I clear?
Yes, sir. Yes, sir.
Okay. In fact, nice that PVS has laid down the foundation as to how Indian companies have to operate outbound in Oman and all that. So I would try to give a perspective how Oman companies, if they do business in India, and I would be more tax centric, and I mean how the taxes would operate and all that. So in the first place, it is very heartening to note that the bilateral trade between both the countries is really taking a big leap from US dollar 5.4 billion in 2021 to almost 9.94 billion in 21-22, which is more than 82.6% increase. And both countries are eagerly, working forward to make the bilateral trade more robust and more progressive. That's a very heartening thing. And in fact, the Joint Commission meeting that has happened on 11th May 2022 has also, of course, at the threshold, in fact, India really appreciate and lauds Oman for accepting our Honorable Prime Minister Modiji's One Sun, One World and One Grid initiative, ratifying the International Solar Alliance. So be that as it may, we really look forward for a lot of inbound investment that might come into India. And in fact, it is very heartening to note that from the Indian corporate world, the outbound investment has almost touched 7.5 billion US dollar into Oman. And whereas into India, in just a period of 9 months, it is inbound investment of 558.68 USD million has come from Oman. So in this backdrop, there is also an initiative made by both the ministries, both the negotiating ministries at the external affairs, that the treaty must be renegotiated and a protocol must be brought in. That is what we could understand from the press release. Probably they would bring in more proactive tax reliefs in the protocol. That is what let us expect. And in fact, there is also a move to bring an investment protection agreement. That is very important. In fact, we have seen in the international tax dispute sometimes the bilateral investment protection treaty is very, very essential. And in fact, that is also in the offing. And in fact, to facilitate trade, probably now there is an effort to bring a very acceptable trade agreement between both the countries. The privileged trade agreement is also in the offing. And I think for pharma industry, there is going to be a big support and encouragement from Indian pharma into Oman. And same way we might look from the other side also, because the India pharma and the pharma players who have already been registered their products with the US FDA, UK MHRA and European EMA are now allowed to trade those products in Oman. That is also a very heartening news. And in fact, coming to the tax incentives, what India can offer for the inbound investments, in India, as we don't offer any tax incentives specifically to foreign investors, nothing like that. But there are some provisions specially designed for non-residents and foreign companies in our tax code, in our income tax law, which are like 44B, shipping companies, shipping business carried out by non-resident who can avail a presumptive income proposition of 7.5%. And same way 44BB is a very popular provision which deals with the non-resident providing services or facilities in connection with our supplying plant and machinery on hire to be used in prospecting for or extraction of a mineral oil. That is a very popular provision where 10% presumptive taxation can be, resorted to by the inbound investors coming from Oman. And same way you have 44 BBA with respect to the aircraft, where the presumptive income, operation of aircraft, presumptive income can be at 5%. And 44 BBB is also a very popular provision. The foreign companies engaged in the business of civil construction who are going to help the turnkey power projects. Here, the fourth one is exclusively only for the foreign companies, whereas the other three which I have spelled out are available for non-resident, covering even a foreign company also. And in fact, coming to the 47, section 47, Mr. S.P. Singh also wrote a mail that we should highlight something about the capital gains exemption, especially in respect of amalgamation and demergers. There are also certain provisions like 47(6)(a) which talks about amalgamation of two foreign companies, and in the process, if the shares of an Indian company are getting transferred from amalgamating company to the amalgamated company, provided 25% of the shareholders continue in the amalgamated company, then definitely they can have the exemption. Same way we have exemptions for indirect transfers. We all know indirect transfers is a very popular topic after the Vodafone's case in 2012. And there is a retrospective amendment and knee-jerk reaction from the government and all that we know. Even in the context of indirect transfer, if 25% of the shareholders continue in the amalgamated company, even though the underlying asset is lying in India, there is a exemption available from capital gain. Same way we have provisions for demerger also. For want of time, I'm not going into specifics. So what I mean to say, the Make in India slogan what we have, and we have a 15% tax rate for domestic companies. Probably foreign company operating a permanent establishment in India may not be able to avail that, but if at all they set up their own wholly owned subsidiary in India, which becomes a domestic company, can definitely avail the concessional rate of 15% which is available. In fact, the India-Oman tax treaty offers certain unique features which I am going to discuss at length at the question answer session when moderator will take us through. But briefly, I would touch upon some unique features what India-Oman tax treaty is having. Especially the tax-sparing clause, what is there in Article 25, talks about if at all there is any tax incentive is provided by one of the contracting states as a matter of promoting the economic growth, then definitely the tax-sparing would kick in. And we have a very interesting case which I will discuss at the time of question answer. And the tax-sparing what is provided in this particular treaty is more elaborate in the sense it can accommodate more sort of proposals than the specific tax-sparing what we had in the other treaties. That is one thing. And we also have a force of attraction rule, which also I will deal at length when we go into the specific questions. But very interesting, the directly or indirectly is attributable to the PE in India. Whether indirectly can cover something which is spelled out in the United Nations Model Convention Article 7 is what we are going to discuss when we go through the treaty. And interestingly, we have very concessional tax rates compared to 115A with respect to dividends and royalties and all that. That also we will discuss. And I think the investment climate is very conducive for Oman investors to get into India at this point of time when there is an active proposal to bring in a protocol to the existing India-Oman tax treaty. And at this point of time, I would like to stop here for want of time, and we can elaborate more when the questions unfold from the moderator.
Thank you, sir, for enlightening us on the inbound investments in India and also touching upon the clauses and special features in the India-Oman DTAA. And Now I would like Ashish sir to continue and give us throw some light on the Omani tax perspective.
Thank you so much. Pleased to be a part of this session for today. When we talk about Oman, means for the people who are planning to come to Oman, I always like to share with them certain aspects on geodynamics of Oman. Now, if you would see the map, Oman is one of the 6 GCC member states. While Oman is called as a member state, but it is like a country of its own with its own laws and everything like that. Means I have heard people asking me that whether Oman is a part of Saudi Arabia. Answer to that is no. Oman is a standalone country of its own and with a lot of things and a lot of maturity on the ground. So from a geodynamic side, we share our land border with the UAE, where there is a lot of growth, a lot of futuristic things are being done. The next side of the border is with Saudi Arabia. We have a very long border with Saudi Arabia. Recently, now there is a direct road connectivity also opened up at the land border. Earlier, there was a desert and nobody could go through it, which is bringing in a substantial amount of trade to us. Then on the southern side, we have Yemen, which could be like a disputed, say, kind of a place, but Oman on its own plays, that role of being the diplomatic hub of the region and trying to resolve the issues for that. And completely on one side, we are facing the sea. So if you ask me, if you look at the location of Oman, the ports of Oman are much more open to the sea rather than going to a UAE where you need to cross the Persian Gulf and go around the Gulf. So if you ask me, the port of Sohar, Duqm and all these places, geographically they are very well placed and which can bring in significant avenues to trade with the world. And our nearest place, like if we start from here, the next land border we hit through the sea is obviously going to be India. So India and Oman have always been a very close trade partner in the past, and going forward also we see a lot of the corridor or the movement going in from one place to the other. So to start with, now bringing the geodynamics to tax. As of today, I would say there are 2 significant triggers in the region because of which we have a lot of questions coming in globally for investments into Oman, and predominantly from Indian business houses who want to set up their hub or places in Oman. So the first point is that recently, as recent as 2019, just pre-COVID, Oman has opened up the overall sectors or overall economy. Earlier, there was a requirement to have a 30% Omani national or a GCC national as a shareholder, and only 70% shareholding in a company was reserved to foreign shareholding. So there have been changes as a part of the commercial companies law, read with the foreign capital investment law, by way of which now 100% foreign ownership is allowed, and that also this can be done by way of a single shareholder. So what they have done, that they have opened up the country and they are allowing 100% foreign ownership with a concept called as a single person company. So we will go through the various legal setups, because from a tax side, what kind of a setup you are in Oman will be a very crucial aspect, which we will cover in the next part of the session. So the country being much more open is a trigger where we see a lot of inquiries coming to us in terms of people want to set up their businesses in Oman, and along with that, Oman is really trying to promote the concept of free zone. When you hear the concept of a free zone, you will always think about the special economic zones that we have in India, or the free zones that we have in UAE. So Oman is working towards something similar. The concept of a free zone here in Oman is also pretty much mature and works in tandem with a very mature corporate tax regime. So we have a lot of clients who are now recently setting up in free zones where they can clearly claim the exemptions from corporate tax and various other benefits which are offered on the ground. So this is the first point, that the overall mindset of the government is such that they are completely open for investments. And going back to the geodynamic side, Oman is broadly a country, must be the size of Maharashtra, with a population of only 42 lakhs. So you can see the opportunity. Okay, there is a clear-cut abundancy of natural resources also on the ground. There is a lot of push from the government to develop this place as the tourism hub of the Middle East. To share with you, the southern part of Oman, specifically called as Salalah, okay, that has a climate like our Konkan region where it rains. So right now we have got a lot of rains over there. We have actually seen a lot of industries being set up over there from the GCC food security perspective. There are a lot of sugarcane plantations. So with all of this, not many people know that Oman is a very diversified place. So with the attitude of the government trying to open up, we see a lot of inquiries coming into us. This is the first trigger point. And the second point, which is my speculation, okay, which I believe is the trigger that we will see in the next few days, how Oman is going to transform into a business hub for the region at least, or possibly for the world. So till now, when we think about Middle East, we always first think about Dubai. Okay, so we have a regime now coming up over there in Dubai, that all the companies in the mainland will be subjected to a corporate tax, starting with a rate of 9% and co-mingling this with the global minimum tax of 15%. There is going to be a mature corporate tax regime in the UAE, along with the global minimum tax, the OECD side, the pillar 2 co-mingling with this. So historically, when people thought about the Middle East, they always created their structures based out of UAE, maybe not from the mainland, but maybe from the free zones. And now, with this corporate tax also going live within the UAE, it might be an opportunity for businesses to think beyond only just tax benefits. Okay, UAE will have a corporate tax regime. Oman has a mature corporate tax regime for quite some time. And with that, my view says that Oman might be compared to that of the UAE and the regional GCC member states for the purpose of investment. And when we look at Oman location from a business perspective, it is much more attractive. Okay, it has a lot to offer, and last but not the least, it is completely unexploited. So with this, I will take a pause over here. I hand it over back to the moderator to take the session forward. Thank you.
Thank you, Ashish sir, for putting things into perspective for our participants. It was wonderfully put. And so I think Srinivasan sir has something to add.
No, nothing at all. I'll wait for the questions, and the way you take it forward, you're the moderator, I'll be guided by you.
Thank you. Okay, so getting ahead to the questions. So for Ashish sir, there's the first question is, what does an Indian business need to know from Omani tax perspective when executing contracts and conducting business in Oman without setting up local presence? Because you touched upon different business entities and different taxation regimes for them. So if someone doesn't want to have a local presence there, then how should they go about it?
Sure, and very good point. This is where most of my time goes during the day when it comes to corporate tax. Because what we have here in Oman is that we have a concept of PE. Okay, there can be a permanent establishment even if you don't have a locally incorporated company. and that permanent establishment can ideally be set up in three ways. It can be a fixed place PE, it can be an agency PE, and the third and my favorite is the service PE. So we have landed up in situations where there are businesses from India, okay, specifically being subcontractors for engineering businesses in Oman, maybe some of the supply chain involved in the oil and gas contracting space. Now, how do they work is that they will have their people come down here into Oman, they will execute a particular project, which could be a subcontract from a local main contractor, and this, okay, by virtue of having people on the ground in Oman or providing services in Oman for a period of more than 90 days, okay, kind of mandates them or kind of exposes them to create a permanent establishment. Okay, so this is the first thing that an Indian business should keep in mind, that whether there is on-site presence or no, these aspects, that whether the Indian business creates a PE in Oman, should be evaluated. And what we have seen in the past is that, okay, businesses have been pretty prudent because everybody knows the concept of permanent establishments and have established permanent establishments also. But how it works in Oman, that once you create a PE of a foreign company, okay, you will get a tax file number or something similar to a PAN card, and that will be your tax registration on the ground. Now, being done that, this is not a company still, it is just an artificial creation of the tax law, and it is a permanent establishment. So we have a situation where the foreign company will be subjecting its revenues to corporate tax, will be drawing up separate financials. The Omani income tax law mandates you to draw up audited financial statement for Oman operations. So there is a need to conduct an audit, okay, and on the basis of that, the PE will be paying corporate tax. But what we have observed in the past is that just because of the maturity of the customer that this foreign party deals with in Oman, and the fact that the payment by the Omani customers will still be made into a foreign jurisdiction, there is a deduction of a withholding tax. So we have seen a lot of practical cases where a foreign business is subjecting the revenue, subjecting it to paying the corporate taxes, but at the same time is getting subjected to a withholding tax. Okay, and while this may look like a TDS, but unfortunately, as per Omani law, the withholding tax and the corporate tax cannot be set off in normal course. So we have seen cases where foreign businesses are paying corporate tax and they are being subjected to withholding tax also, which is not a very good place to be in, because whatever be the commercial understanding, withholding tax, trickles in if the payment is made abroad. So these are the first part of the challenges that a foreign business should be looking at, that whether they create a PE, if not, whether they'll get subjected to withholding tax, or a worst case is there, both coming into play. While Oman and India have a DTAA in place, okay, there is a withholding tax which is deducted for services from Oman side, okay, which we go down the session, we will understand how we claim the set off of that in India, but there is a withholding tax from Oman side on this. Now, this is from the corporate tax side and the withholding tax side. A crucial fact to know is that recently, with the implementation of VAT, there is a concept called as a fixed place from a VAT perspective. So as we have PE in corporate income tax, there is a fixed place from VAT perspective. So suppose for some reason, okay, there is a company which is providing B2C services, and we have got a live case, okay, that there is a company from India which is providing business to consumer services on the ground in Oman. Okay, this company may be exposed to a non-resident VAT registration and they will be obligated to pay the 5% VAT in Oman. Now this, with the VAT coming in, there is a complicated aspect that whether this company also creates a permanent establishment from a CIT perspective. So, there is a very classic commingling as you would have in any mature jurisdiction of a CIT, withholding tax and VAT, all the three aspects working in tandem. And from a total compliance side in Oman, we need to do all the compliances on a tax portal, okay, where all of this can be easily tracked by the tax department. So when say a business is going to create a permanent establishment, okay, there will be a question asked that where is the VAT number for this, and if you are getting a VAT registration, there will be a question asked that where is your tax file number. While from a VAT perspective, if you are dealing from business to business, there could be options to go under reverse charge as well. But these are the three broad things that an Indian business should be keeping in mind from an Omani perspective if they are not planning to locally incorporate an entity.
Thank you, sir. I think there's a follow-up question by one of our participants. A very quick, is there any minimum percentage of local employees for Indian companies in Oman?
Well, that's a very good point, and this is one of the things that most of the foreign businesses are kind of concerned about, is that Oman is presently going through Omanization, which means that there is a lot of push from the government to hire local workforce. Now, because of that, okay, there are certain higher obligations in hiring local manpower rather than getting expat visas. Okay, and I may not be in a position to answer whether there are any specific benefits given for Indian nationals because there are none. Okay, because there is no such distinction as whether means the shareholder is from India or whether the shareholder is from Europe. For that matter, okay, I just wanted to share with you, if you ask me, this aspect, specifically Oman and the United States have a free trade agreement in place. Usually the free trade agreement overrides only the applicability of customs duties, but this is a particular free trade agreement where it says that for the purpose of investment in Oman, a US national or a US incorporated company will be considered as good as an Omani national or an Omani company. So there are, just to answer the question in summary, there are restrictions, I would say, in terms of getting expat visas, okay, for a newly incorporated entity. These might depend upon the location where you have set up. There are certain relaxations if you do it in the free zone, but these requirements are pretty dynamic. The Ministry of Manpower, I would say, keeps changing this on a monthly basis. So my advice to you will be that this will be best checked with a local law firm who are much more connected to the Ministry of Manpower and understand the conditions, because how many expat visas you can get depends upon several factors, not only just from the aspect where the investment is coming from.
Okay.
Just a minute, Ashish, if I
Yeah.
ask this question in a very simplest manner, that if suppose I want to hire 10 people in Oman, how many I need to keep minimum local, 30%, 40%, forget about the visa. If suppose I want to employ only 2 people, then what will be the percentage in terms of percentage or any number, minimum number is there for that? Because that is very important question we need to answer.
Okay, sure. So this depends by the sector by sector. Like if we are a CA firm here in Oman, our minimum Omanization percentage is 55%. So just just on a very broad basis, sector agnostic. Okay, a summary answer to this will be that if you want to hire one expat, you need to have one Omani, where the minimum pay for an Omani is 325 Omani riyals per month. So it is broadly 1 to 1.
to one. And for example, if you are hiring a CA, so you need to hire a local accountant there, or designation can be anywhere.
Well, this is a designation agnostic as of today. So
Okay, very good. Thank you. Rishabh, continue.
Okay. So we have touched upon the permanent establishments of Indian companies in Oman. So I would like Prasad sir to tell us about what are the provisions in respect of taxation of business profits of Omani companies who have a permanent establishment in India, and also touch upon the force of attraction rule as you mentioned in the introduction.
Yes, Mr. Rishabh, I will take you through the important provision connected to the business profits. In fact, Mr. Ashish has talked about the PE in Oman, and we are now talking about the PE of a Oman entity in India. And in fact, when it comes to Omani company having a PE in India, Article 7.1 talks about permanent establishment doing business. Business being carried out in the source state through permanent establishment. And there is a sort of attribution to the permanent establishment. And we have a very interesting provision in Article 7.1 which talks about the profits of the enterprise may be taxed in other contracting state, but only so much of them as is attributable directly or indirectly to that permanent establishment. This is where we need to really examine what is meant by indirectly. Direct, we are all knowing about it, and direct, we have a concept of attribution of profits to PE on the basis of FAR analysis and all that. Of course, the authorized OECD approach, whether it is acceptable to the Indian government or not, we have our own reservations. We are not going into that for want of time. The main feature which I want to explain here is what is indirectly has been explained in the subsequent paragraph of Article 7.1 of the treaty, which says directly or indirectly mean the purposes of this article that where a permanent establishment takes an active part in negotiating, concluding or fulfilling contracts entered into by the enterprise, then notwithstanding that other parts of the enterprise have also participated in those transactions, there shall be attributed to the permanent establishment that proportion of the profits of the enterprise arising out of those contracts as the contribution of the PE to the transaction bears to that of the enterprise as a whole. That means here the succeeding paragraph of Article 7.1 is talking about if at all the PE is involved in negotiating and concluding contracts apart from its regular business, some part of the profit relating to that contracts must be attributed to that PE. And that has been measured from the perspective of contribution. So when we talked about this, what we meant by indirectly, there is a discussion before the tribunal, honorable tribunal, whether this would amount to kicking in force of attraction as per the United Nations Model Convention Article 7.1, which talks about same or similar kind of goods or merchandise or same or similar kind of business activities or services. So the Linklaters case, Mumbai bench of the Honorable Tribunal took a view that the same wording we had in India-UK tax treaty, so which was examined by the Honorable Mumbai bench and took a view this wording would amount to force of attraction rule, that is the limited force of attraction rule. In fact, full complete or full force of attraction rule is not there even in UN Model Convention. It is only same or similar kind of goods if they are traded directly by the parent sitting outside and that would kick in. So there is no full attraction at all. That is not for our discussion at all. The limited force of attraction is also canvassed or advocated only by the UN Model Convention and not by the OECD. So be that as it may, when it is examined by the Honorable Tribunal, Mumbai Tribunal took a view that this wording, the same wording what we have in Oman Treaty is there in the India-UK Tax Treaty. A view was taken by the Honorable Tribunal that the force of attraction, what is akin to Article 7.1 of the UN Model Convention, will kick in. In that scenario, what happens, not only what is attributable to the active involvement of the PE that is to be brought into tax in the source country, but also the other portion of the profit can also get attracted for tax in India, which is an undesirable consequence. So this has been later examined by the special bench, if again Mumbai special bench, in the case of Clifford Chance in 2013. The original case of this Linklaters happened in 2010, and 2013 Mumbai special bench of the tribunal examined this issue, and again in the context of India-UK tax treaty, and found that the inference drawn by Mumbai division bench in the past in the Linklaters case is not acceptable, and they took a view that when the wording is so clear mentioning that as per the contribution what is attributable to their role in actively participating and concluding contracts alone must be attributed to the PE in addition to what PE is earning by doing a direct business in the source country. So that way we have a sanction from the special bench. Be that as it may, again Delhi bench in the case of Shanghai Electric Group Company Limited, that's a Chinese company in the context of India-China tax treaty, where they don't have similar wording in the tax treaty. Of course, India-China tax treaty is revamped totally now. That time the wording talks about directly and indirectly, and there is no paragraph that what I read out here. But in spite of it, they took a view that force of attraction rule as per the UN model will kick in. So in this scenario, we need to be careful about attribution of profits when especially the PE involves in promoting the business of its head office in India, sitting in India and trying to participate in negotiation and conclusion of contracts. We have divided views. Of course, the special bench view is very clearly mandating that Article 7.1, the force of attraction, would not kick in. This is one very important thing in the business taxation, and but for that the other taxation, Article 7, is as per the normal provisions we have, and the administrative and other expenses are whatever that is attributable to PE can be claimed subject to the limitations what we have in the domestic law, 44C like thing we have, and all that will be complied with as per the domestic law with respect to the computational provisions. I'll just stop here.
Thank you, sir, for the insight. And as we have discussed about corporate income tax, and I think we can go a little about what are the essential features of the VAT regime in Oman, and how does the VAT regime in Oman compares with the other Middle East countries. Srinivasan sir, would you like to go on with this?
Yeah. Oman levies a 5% VAT on all supply of goods and services. All. There are certain exceptions, but for a broader understanding, the corporate tax is levied and the VAT is levied, so that there is a overlapping of the two tax regimes, and we are able to carry on business having the totality of context. Assuming that goods are exported from India into Oman, or there's an import of goods into Oman, if it's a B2B supply, it would certainly liable to a reverse charge, and it will be covered by the importer. There is no requirement of registration for the exporter from the other country. If it is a B2C supply, there are certain conditions where you may have to register, but those are where where registration required for VAT may be required, and that is what even Mr. Ashish did mention, that there can be some kind of a confusion at least whether the registration obtained for VAT purposes is also a registration for PE, and both have to overlap. My limited understanding is both are distinguishable, because goods are still being exported out of India, except that the buyer is not a B2B buyer, it is a B2C buyer, and therefore a registration is only for VAT purposes. There can be inquiries with you, but that inquiry is limited to clarifications, in my view, it may not result in taxation because export of goods and import of goods into Oman is clearly kept out of the tax regime as long as no services are performed in Oman. For example, if you have a installation and execution project along with supply of goods, then it can create a PE and the entire profit may be subject to some kind of a taxation based on, of course, the PE, whatever is the attribution rules are there. So I would possibly think that supply of goods should be separated from supply of services wherever possible. And if this broad hygiene is maintained, export of goods should not be liable to tax. It should not have a VAT consequences for the exporter. The importer will take care of the VAT. For B2C supplies, there may be registration and filing requirements which can be taken care. That is one part of it. As far as B2 services are concerned, local supplies of services would be certainly liable to 5% tax like goods are. But import of services, if it's a B2C service, it will be VAT on the reverse charge basis at 5%. If you have local supply of services, suppose you have a PE, then it may create a PE applying the 90-day rule. And of course, the PE in turn will do a forward charge to the end customers whenever it's possible. So there is a withholding tax, which is a requirement of services. And you find most of the services are subject to services is not necessarily to be FTS under the Omani rule. And I can even say sometimes in Middle East, the narrower definition of treaty also sometimes it doesn't get applied. They apply the local law of withholding tax. And so the broader services would be subject to withholding tax. So if you look at the VAT regime combined with the the local withholding tax regime, you will find that import of services may be subject to both VAT on a reverse charge basis and withholding. So the person, Indian exporter of services will suffer a withholding tax in Oman if the service are from India still 5% tax, and this is how the regime operates. So if I summarize it, goods exported from India into Oman, there should not be any liability. There may be a requirement for registration for B2C supplies. The reverse charge would apply on import of goods in B2B supplies. Services, from export of services from India, it will be liable to withholding tax even though services are not performed in Oman, and it will also be subject to reverse charge in a B2B supply. In B2C supply also you may be required to register and discharge services as 90-day presence of within UAE to your personnel will create a PE, and that PE will have to be also along with the withholding tax. This is how the regime completely operates. I will look for any guidance from Ashish. He is closer to implementing these laws on a daily basis. If there's a finer understanding required, I'll request him to comment and enhance the discussion.
Yeah, sure, sir. Means I would say that if you come up and set up a CA firm here in Oman, I will be out of my job. So I think you have beautifully summarized, how the VAT regime operates in Oman. I would like to further highlight that how the Oman law is different compared to that of the VAT laws in the region specifically. Okay, because this VAT coming to the Middle East and to the GCC countries has been going on for quite some time now. That is the reason I am here in Muscat. Otherwise, I wouldn't have been there. So this is a very significant part of our life. Okay, so I wanted to share with all that the Oman VAT, as it is being implemented on the ground, it has nitty-gritties of its own, which, Indian businesses specifically should be keeping in mind. First and foremost, okay, there are 518 food items here in Oman, which are specifically zero rated. This is a specific carve out done only for Oman other than Bahrain. So out of the 6 GCC countries, we have VAT in 4, which is Oman, Saudi Arabia, UAE and Bahrain. Now out of these 4 countries, only Bahrain as a country where they have about 100 food items which are zero rated. Oman has got a step further and they have zero rated 518 food items which are based on HSN codes. So, for my day-to-day dealings, it is very difficult and complicated because we have a lot of imports coming in from India. Okay, so which of these items specifically in the food sector are going to be 5%, are going to be zero rated is a debate that we most likely have from Oman side, and it is limited to Oman and Bahrain only out of the 6 countries for today. So, which is a very significant difference. And from an Oman side, of course, this is much greater because they have brought this in to basically keep down the inflation, because the fear of the government was that with the implementation of VAT right in the middle of COVID, this might push up inflation significantly. So this is one sector where Oman does a lot of trade with India, is the food industry. The second is, okay, where also Indian businesses have a lot of presence. First is healthcare and second is education. These two sectors, compared to that of the GCC, okay, if you look at UAE, Bahrain and KSA, these two sectors are zero rated. Unfortunately, I would say from an Oman VAT perspective, these two sectors have been put in the category of exempted. So what does this mean? That if a school or a hospital is going to buy certain equipment, say like a laptop or medical equipment, they will be subjected to 5% VAT, which they are not able to recover the credit because their output is exempted, which is, trying to push up the cost of doing business of these two sectors in the country. So we have a lot of hospitals from India, okay, the very renowned chains operating in Oman, and now they are struggling with this because it is not only about not claiming the VAT which is getting charged, but it is also about reverse charge. Now, as these hospital chains, okay, have, a tendency to pay a royalty or a management fee back to India, okay, which could be subjected to a withholding tax. In addition to that, they are now supposed to pay 5% VAT under reverse charge only for this. So, which is a little bit, area of concern. To the best of my knowledge, there have been representations filed with the Omani government tax authority asking to move this from exemption to zero rating. But, all of this is forming part of the royal decree, and changing the royal decree, like, we used to see in India, if you want to change a law, there is a legislative process. So here also in Oman, we may need to follow the legislative process. So that as of today looks a little bit difficult. So barring the procedural aspects where there should be a responsible person in Oman who should have an Omani ID to be the responsible person for VAT. There are these three sectors, which is food, healthcare and education from a VAT perspective, which are very different in Oman.
Thank you so much for your comments. Sir, would you like to continue upon what are the legal setups available for Indian organizations to set up in Oman, and how does the tax regime vary across those setups?
Yeah, sure, Rishabh. So, like I said at the start, that for a tax consultant to operate in a particular jurisdiction, it is very important to understand what are the various setups or the legal status of the taxpayer. So, relevant to the discussion for today, which is coming investments from India, okay, there could be, permanent establishment. Okay, so when we speak about permanent establishment, overall the tax rate applicable on that from an Omani perspective is 15% of your returned income. Okay, but unfortunately, going back to the aspect which Prasad sir was saying, that how do you attribute your profits to a particular PE? So I will just give an Omani perspective on that. So the Omani perspective is that the contracts which you are executing in Oman, they should be ideally subjected to the corporate tax, and profits arising out of that should be subjected to corporate tax in Oman. That is the concept. But there is one provision in the domestic law in Oman which says that for permanent establishments or for branches of foreign companies, the deduction is limited to 3% of the turnover. Now, when the deduction is limited to 3% of the turnover, that is the only deduction ideally a PE or a foreign branch can claim in Oman, but it has an exception. This is where the gray area comes in. So similar to the DTAA clause, it says that if there is something directly attributable to the business of the PE, then you can claim that deduction over and above the 3%, and in certain sectors it is 10%. But this is a gray area. So from an Omani perspective, when I am dealing with like a tax assessment of a permanent establishment or a branch, I need to be very careful while I have audited financial statements to support me. But the tendency of the tax inspector is to deny anything above 3%. So if that be the case, if you are looking at overall, I am kind of exposing my entire revenue earned in Oman for the purpose of 15% corporate tax, subject to the 3% deduction. So it is a very complicated place to be in. That is the reason. When a foreign business is looking at setting up into Oman, it should look at certain other optimal options, which could be setting up a limited liability company, which has 2 shareholders with 100% foreign shareholding, or maybe a single person company with 100% foreign shareholding also. So if you are set up as a limited liability company or a single person company, this 3% cap is not there. The 3% or the 10% cap is not there. So we have spoken about branch, we have spoken about permanent establishment, we have spoken about limited liability company and single person company. These are the usual ways in which a foreign business setups into Oman. In addition to that, there are these public joint stock companies, which are the listed companies, as we call it SAOG. And there are joint stock companies, but which are not traded and which are closed, which is referred to as SAOC. Now, as per the commercial companies laws in Oman, there are very stringent directives of each of the company, that what is the requirement of share capital if it's an SAOC, SAOG, what should be the board of directors, who should be the shareholders. There are very detailed guidance in that regard, where we as an audit firm, while doing audit, need to focus on those aspects very carefully. So why I wanted to bring this aspect specifically is to share with the audience that if you are going to have a business here in Oman, and if you're really planning to set up an entity, please do evaluate the various types of setups you have, which may be optimal from a tax perspective. Just to share with you, if you have a limited liability company or you have a single person company, if that company is paying out a dividend back to India, it is not subjected to withholding tax, vis-a-vis if it's an SAOG listed company. So, and this also, there is a specific COVID relief plan. It has been relieved for some time, but when I compare a listed company SAOG with a limited liability company, the limited liability company payout of dividends is not subjected to withholding tax, nor does Oman levy any kind of a dividend distribution tax. So this, what we from our world call as an entry strategy, evaluating a business from a tax perspective, it is a very crucial aspect. And when we take this setup to the free zone, okay, so suppose if you want to evaluate certain free zones in Oman which may have tax holidays from corporate tax perspective, okay, it will be surprising to note that that holiday does not extend to withholding tax, by the way. So suppose if you have any royalties or services being charged into a free zone company in Oman, it is still subjected to withholding tax from an Oman side. So there are broadly these various types of setups that you can explore as a foreign investor. Okay, we can spend almost a day on the nuances of each and about, but the short message is that you should keep in mind, the tax aspect also when you are setting up a company in Oman.
Thank you, sir. It was wonderfully put. And now switching back to the Indian perspective, Prasad sir, the next question is, what are the provisions for taxation of royalties, technical service and dividends under the domestic income tax law in India, and how does the DTA between India and Oman influence it?
Yes, Rishabh, in fact, royalties, fees for technical service, and these are the regularly encountered issues, interest and dividends and all that. And in fact, the treaty provides, the India-Oman tax treaty provides a 10% dividend tax. For those companies who are holding more than 10% stake in the dividend paying company. And of course, in all other cases, it's 12.5%. And here, when we come to the 115A, probably the foreign dividends may be taxed at a higher rate. So thereby, it is sometimes it is more beneficial to go through the treaty rate as we have here. And especially from the Oman investment into India, where you have where you are going to receive the dividends I am talking about. In the same way, when we go to the technical fees, when technical fees is paid out from India and the source is happening in India, and what is the tax rate we have under the Oman India tax treaty is 15%. The article is titled as technical fees. We don't have any clause like make available clause, what we have in the India US tax treaty, UK, Netherlands, Australia, and all that. So that way it's a regular technical fees. The provision which is akin to the definition what we have under the domestic law. So, but here it's interesting. 115A offers 10% along with education sets and surcharge, whereas the treaty is prescribing a rate of 15%. See, this is where you will have to hop in and hop out, which is more beneficial as per section 90 subsection 2. The provisions of the treaty are provisions of the domestic law, whichever are more beneficial are available to a non-resident. When we come to the royalties, it is 15% rate what we have under Article 13.2 of the Oman Tax Treaty, whereas it continues to be 10% here in the 115A. So this is how one has to look which is more beneficial. And in fact, we have jurisprudence to provide that for one stream of income, you can go under the provisions of the DTAA. For another stream of income, you can come under the provisions of the the domestic tax law, whichever is more beneficial. So that is where we need to apprise these issues or analyze these issues on a year-to-year basis. And one more point I need to add, if at all these streams of income are effectively connected to a permanent establishment, in all the articles which I have read out from the India-Oman tax treaty, definitely they would be treated as business income under Article 7 and the respective specific articles would not apply. If at all such streams of income like dividend, interest, royalty are effectively connected to a permanent establishment, that is what we need to bear in mind.
Thank you, sir. I have a follow-up question for all the panelists. I did some research on the India-Oman tax treaty. So, as you rightly mentioned that in the royalties and the fees for technical service articles, the treaty states the 15% rate for withholding. Whether as in the Indian domestic law, and if I'm not wrong, Ashish sir, please correct me, in the Oman domestic law also the rate is 10%. And I think Oman is the only GCC country with India which has a 15% rate for these articles. And similarly, from the side of Oman. So is that a policy decision or it's just following the model, or why it has landed up like that?
Yeah, that's a very good point. In fact, we deal with this kind of a query on a day-to-day basis. So we have, because of this kind of an ambiguity, a treaty versus the local law, we have confirmed this with the tax authorities in Oman. And the guidance provided to us is that we need to go as per the Omani income tax law, which also has a clause on withholding tax and says that the maximum rate is 10%. So even if there is a 15% mentioned in the treaty, from an Oman side, the deduction, if applicable, it will be done at the rate of 10%. And how we deal with it, that we get a withholding tax deduction certificate from the Omani tax authorities, and I have been told that this is available as a set off in India if there is an effective a tax liability for that particular year.
So can we have some Indian perspective on this as well?
No, Indian perspective, Rishabh, we have Circular 333 of 1982 clarified by the Central Board of Direct Taxes that we can always go whichever rate, whichever law provisions of the law which are more beneficial. So that has been repeatedly confirmed by the courts of law on the basis of the Circular 333 of 1982 given by the CBDT, and we have number of cases which have supported that. So there is no ambiguity on that. Wherever the provisions of the domestic law are more beneficial, definitely you are going to be covered by that. The basic principle in international taxation is treaty is never imposing in nature, it is always relieving in nature. So treaty might have prescribed a rate which is higher than your domestic tax rate. See, if you remember 115 years sometime back, almost some 10 years back, there was an effort to bring that rate up to 25%. Just for 1 year it was there. And that 25% again is brought back to 10%. So that way the domestic law might change year after year, but the treaty would remain static unless both, static in the sense unless both parties come for a renegotiation, and the treaty amendment cannot happen on a unilateral basis. That is the reason sometimes the treaty rates might be disadvantageous. Even 15% is available even in India-US tax treaty also. So that is the reason there is no specific policy. At the time of negotiating the tax treaty, you might have arrived at a rate which continues to be there unless it is modified by bilateral negotiations. But the domestic law provisions keep changing. So whichever is more beneficial, you can always go under that. Non-resident is eligible to be governed by the more beneficial provisions.
Thank you, sir. Talking about the withholding tax.
Sir, I may add.
Please, sir.
The treaty was executed in 1997,
yes.
And we are now almost 25 years after the treaty got
yes.
negotiated and concluded. So normally a restatement of a rate takes about a couple of years of negotiation between the countries. If both the countries have access to domestic law to 10%, and if there's a foreign trade agreement which is in progress or in negotiation, one of the aspects they may negotiate is also to align the treaty rate to 10%. It was done in Japan, that earlier 15% or 20% was reduced to 10% under the Japan treaty. Likewise, it may get aligned here also. Nevertheless, the more beneficial rate would apply is the discussion we had. Even in the Oman is the case, even India also is the case. Effectively, the treaty rate gets redundant. It doesn't get applied because the domestic rates will prevail.
Right, sir. So taking the conversation on withholding tax ahead, I would like Srinivasan sir to please highlight about the withholding tax regime in Oman and how it compares with other Middle East or the GCC nations.
First aspect we have to keep in mind, which more or less gels with the Indian system of taxation, that withholding also is on accrual basis. That is, whenever you record an accrual in the books, the withholding tax would trigger at that point in time. This compares with the Kingdom of Saudi Arabia. You may find that Saudi Arabia is on payment basis. There is always a difference when tax has to be borne at the point of accrual was payment, because payment can be deferred, but accrual may not be capable of being deferred, considering the accounting system we are all required to follow as corporate laws. Suppose you have a subsidiary in Oman, you may not be able to follow a system of accounting which is cash accounting because it's a subsidiary. You may have to follow an accrual system. So the first principle we have to see is that as and when we record transactions in our books of accrual, the withholding tax would apply. Dividend of limited liability companies has been suspended till sometime till 5th May 2024. This is to allow some kind of a broader vision 2040 of Oman, which they are encapsulated. And therefore, this particular relaxation has been continued. It was there in some form, now it has been continued. So dividend doesn't attract a withholding tax when it is limited by a limited company in Oman to in India, it may be liable to tax because it falls into ordinary dividend is a tax. You may have to pay the corporate tax or the income tax in the hands of individuals. But nevertheless, as far as Oman is concerned, you don't suffer withholding tax. Royalties, there's a 10% tax. Fees, the services aspect of it, it is exactly the definition which is there in the Indian law. So it will be managerial services, technical services, consultancy services. So your R&D services would be liable, management services would be liable, even any other services. Most of the services will get covered for withholding tax regime, and that would be liable to 10% tax. On interest, I will seek a little guidance from Mr. Ashish. My understanding that interest is also not liable to withholding tax, but there are some categories of loans for which this exemption is available, and there are certain categories for which it's not available. I will request Mr. Ashish, because this requires finer understanding. I have a broader understanding of such finer understanding. Question tell a bit more. If the payment is, there is a P, there is no withholding tax requirement, and there will be, is my understanding. Certainly you have to comply with P regulations. The corporate tax is a very stiff regime. The deductibility of expenses is a challenge. So you may find that withholding tax is a better regime compared to corporate tax in certain circumstances, because the rate of tax is lower as far as withholding is concerned. The withholding tax, suppose there is a withholding tax in India, whether it's offsettable in Oman, there is certainly an offsettable mechanism for the withholding tax. For the same income which is liable to tax in Oman, you will get an offsettability of that withholding tax, and therefore the tax which is paid in India may not be wholly a tax by way of an expenditure. It may reduce the amount of Oman tax which the Oman company is required to. So there can be some kind of a coordinated dividend payments, royalty payments between parties. Arm's length principle is applied between related parties. There are no methods as we have in India. But nevertheless, the broader principle is that you must trade between related parties on an arm's length basis. And if this is not adhered, there can be some distortions in the way you withhold tax. The pricing mechanism can be altered. So as far as the withholding, I will say it is comparable very well with Qatar. If I say, if you are in QFC, the Qatar Financial Center, there may not be withholding tax requirement at all. But if you are in a Kingdom of Saudi Arabia, payment as the basis is the most advantageous one. As far as UAE is concerned, they are entering a tax regime possibly in 2023. So now to go to UAE without knowing what the regime will emerge, unless you are already in business. So if you have to do a greenfield business establishment, you will have to keep a little guessing as to what will be the UAE law look like when it comes to 2023. And we are not too far away from 2023, about a year away, if I can say. So we, otherwise at this point, UAE looks attractive on a pure comparison that there's no withholding tax requirement in UAE. And therefore, I would suggest these are the broad principles which we will have to look at it. I'll request Mr. Ashish to comment on loan interest or loan, where I have not clarified. If something more he has to add, certainly.
Sure, sir. So, beautifully summarized, I would say, from a withholding tax side, you have covered all the aspects. Specifically on the withholding tax on interest, you are right. There are certain the categories which are to do with Islamic finance, which are not subjected to withholding tax. And in addition to that, the same Vision 2040 announcement has recently extended non-applicability of withholding tax on interest and on dividends till the year 2025, in fact. So this is a significant amount of a relaxation provided by the Omani the tax authorities on the ground. And just to add on one aspect, okay, because we deal with this on a day-to-day basis, as Oman has got a free trade agreement with the US, Oman has a DTT with close to 35 countries, and the list is getting added day by day. Recently, Oman within the GCC countries have signed a DTT with Qatar, but it has not been ratified and not put into force until now. Barring this, to our surprise, there is no DTT with GCC countries. the normal model that we see on the ground from an Oman side is that there is a central headquartered business in UAE, being a jurisdiction that where there is no tax as of today, and there are certain cross charges which are charged to each of the jurisdictions. Now, when we are in Oman and we are at the recipient end, to our surprise, as there is no corporate tax as of today in the UAE, and nor there is a double tax treaty, so the tax residency certificate doesn't help me. So all payments for accruals shown from UAE get subjected to a 10% withholding tax business, and which as of today is a cost in the business. So if you ask me, announcement about corporate tax now coming to the UAE could be a beneficial news where this withholding tax may not become a cost in the supply chain. Okay, so we are seeing a lot of movement on the DTT progression from the region. There is a possibility that there could be a DTT recently signed with Saudi Arabia as well, because there they have higher number of the taxes on the ground. As sir said, there is a zakat also there, which is which can be compared to our version of wealth tax. So with Saudi Arabia, there could be a DTT in the future, and it will be very interesting to watch with UAE going live with corporate tax, and as the most of the trade in the region from Oman is done with UAE, whether there will be a DTT over there. It will be a very good space for us to watch in the future from a withholding tax side in Oman.
Thank you, sir. So we have seen that there is a broad spectrum of taxes in Oman and how it varies across different legal setups. So can you enlighten us on what are the different taxes that are covered in the AA of India and Oman?
Can I interrupt for a minute, Rishabh?
Sir, please.
I would just supplement, 1 minute I would supplement on royalties and FTS and interest. There is a very important issue from the DTAA angle. Under the DTAA, the wording used is paid. Royalties paid or technical fees paid or interest paid. Unless it is paid, the trigger of taxation would not happen from the DTAA perspective, for which we have a number of judgments. Unlike an accrual basis which may be followed under the domestic law, this is one thing we need to bear in mind with respect to royalties, interest and FTS and all that. So even dividends also, the wording used in the Oman treaty is paid. So that way there could be a variance between when it accrues, when it becomes liable for tax. So there are many judgments from the tribunal and also High Court that paid is the word used in the treaty. Accordingly, it would the trigger of taxation would happen only in the year in which the real payment happens, not otherwise, not on the basis of accrual. I'm sorry, you can just proceed with the next question.
Sure, sir. Thank you so much. I think so that I have also made a note at my end that there is like a discrepancy in the wording as per local law and the DTAA.
Correct.
It is interesting to note that. Coming back to the question that what are the multiplicity of the taxes that we have from Oman perspective. And if I would just summarize rather than listing down the taxes, I would say that we have every other tax in Oman other than personal income tax, which is not there as of today. But the government is working upon a personal income tax regime also. So it won't be long that Oman will be the first jurisdiction in the GCC to have a personal income tax, which may come into effect from the year 2024. So there have been movements around the draft of the law as well. So this will be the last version of the tax which will be done. What we don't have is a transfer pricing regime, I would say. While the domestic law makes references, the VAT law also makes references that the transaction with the related party should be at arm's length, but there is no official transfer pricing regime. There is a requirement for CBCR notification and reporting as well. So all the mature part of the concepts are there on the ground. So just to summarize quickly, we start from a customs duty. So Oman has a customs duty. There is a common customs law for all the 6 countries put together. So there is a single point custom duty. So suppose if the goods are coming through UAE, there will be a custom duty collected only in UAE, and then movement from UAE to Oman will be without payment of custom duty. Or if it comes through a free zone of UAE and it is entering GCC outside of free zone in Oman for the first time, the custom duty will be collected here. Further to that, there is a corporate tax as we spoke about at length. There is a withholding tax as we spoke about at length. To our surprise, there is an excise tax like we had pre-GST in India, an excise duty. So here we have excise tax on 5 called as the sin products which is broadly alcohol, pork, sweetened drinks, energy drinks, and similar sin goods like tobacco. And it's a 50% and 100% tax, similar to the concept we had in India, the RSP mechanism. Then we of course have a VAT on the ground, and in addition to all of that, while there is a lot of push on the tourism, we have something called as the tourism tax and the municipality tax as well. And then there are a lot of transaction based tax on the ground. While we may not have a stamp duty, but if you are getting into a lease or if you are transferring a real estate, there could be certain municipality taxes over there, which also gets covered in the larger ambit of municipal tax. But barring this, maybe at an individual level, relevant to note that as of today, we don't have a remittent tax. Suppose if an individual wants to transfer funds to India, we don't have any percentage of that we need to keep in Oman or anything like that. There is free transferability, as Srinivas sir said right at the start. So I would personally call Oman as a pretty complex tax jurisdiction. There is a lot of multiplicity of the taxes working on the ground. So from a tax consultant perspective also, it is a great jurisdiction to work with, because as we mature from a business side, obviously the concepts of tax will also mature, and we will see a official transfer pricing regime also come into play in the near future. So this is the landscape from a tax perspective in Oman.
Okay,
I
so
may add I may just add a little more that most of the Middle East countries are administrative laws, in the sense you don't tend to litigate. You accept the administrative decision. The ability to litigate and then go to courts are all very limited options. So you have to virtually close all litigation issues at an administrative level. So very extraordinary interpretations on law sometimes will take a lot of time to resolve, because you have to find only an administrative solution, not a judicial resolution. My understanding is, my experience, I'm saying there may be courts, there may be resolution tribunals and all. They are not often used. What is used is you persuade the authority and the hierarchy of the authority. Generally, they are open-minded. They receive your suggestion. But wherever they have taken a position, you may not be able to alter that. And that will be the final tax. That's how it works.
Yeah, and just to add to that, sir, as you would know, that unfortunately none of our countries have a precedence or a judicial judgment where we can rely on. So when Prasad sir was going through so many judgments, it took me back to our law days, where we had the liberty to refer judgments and advise clients on the basis of that. Unfortunately, our jurisdictions are such that all the rulings are private rulings. They are not usually published. Even if they are published, they are certain key ones are published in Arabic text, and doing the translation, the legal Arabic to English, also takes a lot of things. Means we have landed up in situations where just the law, we have had 2 interpretations, and all the legal text, the royal decree as well as the ministerial decision, says that the Arabic text will prevail over legal translations. So it's a very difficult, place to be in for a tax consultant.
Yeah, a lot
We
of
have
persuasion, the ability to be diplomatic, the ability to speak the right language, to strike a cordial relationships, everything works there.
That's right.
That is a wonderful comment, sir. So as we have seen that there is scope for double taxation, so I would like Prasad sir to please highlight how does the avoidance of double taxation operate in the context of the India-Oman DTA, and as you rightly pointed out that there is a tax sparring clause in the DTA. So it will be great if you can tell us how does it operate.
Yes, yes. In fact, the Article 25 talks about the elimination of double taxation. As we understand from the terminology what we have in Article 25, it talks about credit method and talks about Article 2 definition of the taxes, which taxes are covered, what type of taxes are covered in India and what type of taxes are covered in Oman, as explained by Mr. Ashish and PVSG. So that is how the credit method operates in both the places. And then we have a very interesting provision in Article 25(4) that talks about that talks about the tax paying clause. Just give me a minute. I'm just going to read it out. See, when we talk about the tax paying, it is 25(4) says tax payable in a contracting state mentioned in paragraph 2 and paragraph 3 of this article shall be deemed to include the tax which would have been payable but for the tax incentives granted under the laws of the contracting state and which are designed to promote economic development. Very important. In the first place, let us understand what is a tax paying. See, we have SEZ regime in our country, and SEZ is promoted by the Ministry of Commerce for the economic development and improving and pushing the exports to a next level, and all that happens as a overall process of economic growth, and focusing on some of the sectors targeted for further pep up and encouragement. If at all there is any activity of that nature happens, now we have the gift city which is being showcased in a big way in Ahmedabad. So whenever you are giving lot of tax incentives, suppose the foreign company or the non-resident is not taxed here on the basis of the tax incentive, and if he is taxed in the resident jurisdiction, that means the taxing rate which you have waived in the source country is being exercised by the resident country. That means the tax rights would be exploited by the resident country, which otherwise would have been implemented by the source country. So this is where the jurisdictions come to an agreement that what is spared from tax in the source country should also be spared from the tax in resident country on the basis of a deemed tax credit. A deemed, though tax is not paid in real, what would have been payable had there been no tax exemption. So this is what is the tax paying. We have an interesting clause which I read out in India-Oman tax treaty, which says tax payable in a contracting state mentioned in paragraph 2 and paragraph 3 of this article. That means paragraph 2 is talking about what taxes may be taxed in Sultanate of Oman, and the paragraph 3 is talking about taxes that may happen in India. So if at all there is a particular tax is exempt in the source country, let it be Oman or let it be India, the same should be considered as a deemed tax credit by the other country, that is the resident country. What is spared in the source country must be allowed as a deemed tax credit in the resident country. So unlike more elaborate clauses what we have in many other treaties India had, here it is a more broad level or a high level wording what we have, which is giving a leeway for the taxpayer to, invoke this particular provision. For this, we have a Delhi case. There is one society by name Krishak Bharati Cooperative Society, Cooperative Limited from Delhi. The SSC is a multi-state cooperative society. Its main business was manufacturing fertilizers and such as urea and ammonia. It entered into a joint venture with Oman Oil Company to form the Oman Fertilizer Company, SAOC, that is WOMIFCO, under the Omani laws. The SSC established a branch office in Oman to oversee its investments in the company. The SSC filed its return of income and the case was selected for scrutiny. And the Oman tax authorities have issued a letter stating that the dividend being paid out to the Indian shareholder is exempt from tax in Oman to promote economic development. That is very clearly mentioned in their letter what they have issued. So on that basis, the taxpayer made a claim before the Indian tax authorities to provide a deemed tax credit and not tax that dividend which is received from the Omani company by the Indian Cooperative Society. As usual, the tax authorities did not allow that, and it has gone up in the appellate ladder. Right up to the tribunal. Delhi tribunal said that this is a clear case getting covered by the taxpaying clause what we have in India-Oman tax treaty, and thereby they said the deemed tax credit has to be provided, which has been endorsed by the Delhi High Court in the same case. And this is a very interesting issue. And when in my limited research, when I compared this taxpaying clauses what we had in other treaties, here this taxpaying clause is really more accommodative in respect of any sort of new incentive that may kick in any of the jurisdictions. This is how the taxpaying clause very interestingly operates in the India-Oman context, more evident from a live case what we have what I have explained just now.
You beautifully explained such a complex concept of taxpaying in such easy words. It is very nice. And I think, do we have time to proceed forward for a few more questions?
Maybe we can take one or two, I think.
Okay.
Yeah. You can take one or two. Then I have some requests also to the speakers. My net is having some issue, so my picture may not be visible.
Okay.
Okay.
But
So,
we have your metallic voice, sir. Sanjay ji, though we may not be able to see you, but your metallic voice is with us. Yes. Please go ahead.
Thanks a lot, sir. Thanks a lot.
so moving ahead, we have seen the different taxes that are there and how it operates in DTAA. So I would like Srinivasan sir to please give a small comparative analysis of the corporate tax regime compared with the other Middle East and GCC countries with Oman.
Just an overview, because corporate tax, it is not a global, once you go to Middle East, the understanding of corporate tax is slightly different from the way we understand corporate tax in the rest of the world. Some countries treat even corporates like partnerships. Some countries treat corporates as corporates and levy tax. And generally when we see corporate tax, we look at net income, but the ability to deduct expenses are all subject to a lot of local way of looking at expenses. So I would say a headline rate 15% in Oman is comparable with say if you look at 20% on foreign ownership in Kingdom of Saudi Arabia versus 15 in Oman, certainly this compares better. The corporate in Oman is 20% of ownership. So there's a tax in Oman and a tax in Kingdom of Saudi Arabia. Rest of the countries, Qatar has a 10% on foreign ownership, tax on foreign ownership. So if you have 100% ownership, the whole of the profits would be liable to tax at 10%. But essentially, we should not be too worried on the headline tax. It is the ability to compute the amount of income that should be a matter of concern. I think all countries don't have a standard mechanism. Local practices vary. Yeah, 3% ability to deduct expenses sometimes can be highly limiting one, where you almost pay tax on the gross revenues rather than net income. These practices in Gulf need a little finer understanding. For considering that we need to only understand the framework today and not into the finer details, we will park it for some other occasion. But nevertheless, this is how it works.
So taking up, I think we can proceed. This is an open question for all the panelists. That what are the key tax challenges for Indian businesses operating in Oman and vice versa for the Oman businesses operating in India?
Should I take the question first? Because I can reel out something which I really know. Key challenges is what's called the Bhumiputra rules, the localization. How many local Oman employees will have compared to foreign nationals? Unless you operate out of free trade zones, there are certain exemptions for free zones. But otherwise, the localization or Bhumiputra rules, as we understand, that is a very high one. The ability to get expats into Oman itself is sometimes quite a challenge. So these two are important challenges, I will say. The rest of the regime is fairly middle. So if you middle you understand the local administrations quite well over a period of time, so you'll be compared with those regimes. The ability to into and that for expats, I think that is not very easily achievable unless you operate out of free zones.
Yeah, and just to add from an Omani perspective, and this is again a live case. So because of the restrictions on bringing in expat manpower into Oman, we are seeing a lot of offshoring, okay, where Omani companies are setting up shared services centers back at home, or there are freelancers who are working from over there who are on the so-called payroll of the Omani companies. Now, when I compare this with the Omani side of the taxation, and I am claiming the deduction of this salary of this person who is sitting in India, okay, I am not allowed to claim the deduction because the Omani tax authority asked me a contract with the Ministry of Manpower in Oman, which I don't have. So this is a challenge, I think so, from both the country's side, from the tax front. First of all, whether Omani company having its people working from India directly, whether it creates a permanent establishment for the Omani company, and vice versa, how does that person's personal income taxes work? That whether there should be a deduction of a withholding tax in Oman, whether that person can claim like a set off over there. So this is on a direct retainer employment model, or if that company gets into a third party contract or has a shared service center of its own. So these are the areas which we are saying that there are a lot of new questions coming in, specifically because there is a restriction on hiring expats in Oman.
Okay, so I think we can take the last question that would relate to MLI, that is a talk of the town, that I think both India and Oman have also deposited the ratification instrument. So Prasad sir, can you please enlighten us on how does it impact the existing India-Oman treaty?
In fact, as you rightly said, both India and Oman have deposited ratification instruments with OECD, and both are signatories to MLI. Of course, India signed on 7th June 2017, whereas Oman became a signatory on 26th November 2019, and ratification instruments were deposited by them respectively on different dates. And here the interesting, the development or interesting issue, what you need to bear in mind is the MLI would operate only when both the countries notify a particular treaty as a covered tax agreement. India notified all its 93 tax treaties, the then existing at the time of signing the MLI, but whereas Oman has not included India-Oman tax treaty in its notification. Thereby, though both are signatories to MLI, India-Oman tax treaty is not impacted by MLI because Oman has not included this particular tax treaty, India-Oman tax treaty, as a covered tax agreement. That is the status which we can download from the MLI matching database of OECD. So as of now, MLI has no impact on the present treaty. Probably, as I mentioned in the beginning of my presentation, India, Oman would like to renegotiate, probably bring a protocol and all that. I don't know, maybe the minimum standards what are need to be complied with may be brought in the form of the principal purpose test and all that may be brought in the protocol. We will not know because both are signatories to MLI, and the prevention of treaty abuse, which is a minimum standard, must be brought into the treaty. So because as of now, the treaty is not a covered tax agreement. That is what I would like to inform the audience.
Okay, thank you, sir. I think there's one quick question from the participants of the session, and it's regarding that are there any legal requirements to provide the employee welfare activities such as PF, or I think they're talking about social security in Oman?
Okay, so
sorry. Go ahead, sir, please. You're well informed. You'll be able to cover it better.
Sure. So, well, we don't have a social security tax or a PF concept here in Oman, at least for expats, but there is a requirement called as a PASI. So it is by the name going for Public Authority for Social Insurance, and it is applicable for Omani nationals as well as for GCC nationals. Because we being neighboring countries, there is a lot of situations where a UAE national may come and work into Oman. So this is applicable for Omani nationals and for GCC nationals, but not applicable for expats. On the gratuity front, maybe my colleague Unmesh will be able to elaborate further. While this is not a statutory requirement, but gratuity is there.
Yeah, there is the Oman labor law which talks about the gratuity payment. There are some calculations given based on the number of years of service as a percentage to the basic salary the employee would get as indemnity at the time of termination of the services. Pretty simple, same like gratuity in India.
My understanding of Oman is there's a levy of about Omani and Riyal 300 for vocational training on expats for every 2 years. It may be nominal, but it can go into your costing mechanism if that makes any relevance to you.
Very interesting point, sir. And I think with this, I was seeing the Q&A section also. Most of the questions are answered and have been taken care of during the discussion. And even there were a few comments which have been already pointed out by the respective panelists. So I would like to hand over to Unmesh sir to take the proceedings of the session forward.
Thank you, Rishabh. Thank you, Srini sir, Prasad sir, Ashish, for enlightening our members in terms of the tax aspects for Oman as well as India. Like our institute's motto logo, Ya Isha Supteshu Jagarti. So I think to be mindful of the law provisions, especially in Oman, the way they are getting complicated. All the members here and probably who want to work with Oman would be truly living by this, that you have to be very active when you just sleep, which tax provision might affect you at what time. So with this, I'll thank all the panelists as well as the moderator. Just as a token of appreciation, I request excuse me. I request Sanjay sir to felicitate our panelists with a small token of appreciation. It's a simple certificate. I think we can share in an online mode as compared to okay.
Thanks for
Sanjay
the
sir, you're there?
I think he got disconnected.
Okay. Thank you,
Thank
Srini
you
sir,
for
for
the
the insights
certificate.
you have shared. Prasad sir, thank you for the wonderful insights you have shared with all the members.
It's my pleasure. It's my pleasure.
Thank you, sir. Thank you, Ashish, for being the torchbearer from the Oman side.
Thank you, Unmesh. Thanks to make me a part of this, even if I am not a chartered accountant, but pleased to be a part of this elite session.
And last but not the least, thank you, Rishabh, for hosting the panel discussion, keeping everybody busy and active in terms of extracting all the relevant important points which are crucial for the Oman India tax aspects.
Thank you so much. It was my pleasure to share screen with you just virtually right now. Maybe sometime soon physically as well.
Sure, we'll definitely plan. With this now, may I request CS Ajeev to share the vote of thanks for the event.
Hi,
Ajeev ji?
Unmesh. Thank you. Can you switch on my camera? Is blocked?
Your video is off.
Video is on?
It is not on.
Yeah.
Now it is. Yeah.
Hi. Thank you, Unmesh. Before I give the vote of thanks, just few couple of more points to add from my side. The Oman has come up with, any Middle East company in all these days, all countries, they look at the investment opportunities from foreign investors. Here in Oman as also is as looking at the foreign investment, or they are attracting the investment opportunities in Oman with a single window investment, easy investment opportunities, in easy investment. The rules and regulations through the single window, the platform, where the major attraction is the 5-year, 10-year visa for procedures. Probably, you would have heard of the investors visa for 5 years and 10 years. And yes, I agree with Mr. Ashish. He mentioned about the localization and the percentage of Omani's complaints in the business. But at the same time, there is actually an opportunity to get the local suppliers, the manpower suppliers to sort out those issues. So this is the way the large plants. There are the large plants, manufacturing plants in our free zones. There are a couple of, in my understanding, 4 or 5 free zones are there. Right, Mr. Ashish? I think 5 free zones we have, right?
That's right. Yeah.
Yeah. So all these 5 free zones, the regulation is a little bit relaxed as far as the manpower is, and it's predominantly they focus on the manufacturing, which is working fine for a couple of years. Recently, they've added a couple of free zones like Dukum and all, which is coming up very well in the investment map of Oman. And with we should appreciate that the Ministry and Chamber of Commerce has taken all their initiatives to make the investment environment more friendly and comfortable to the global investors. See, with respect to this, the Muscat chapter of Chartered Accountants of India, we have developed a e-kit, which is basically to cover all the tax regulations, corporate taxation law, labor law and all applicable regulations we covered in that. And anyone who wants to, who is interested to look at that, probably you can write to Muscat at ICAI.org. And with this, let me give formal vote of thanks. CA Sanjay sir, thank you for being head of today's event, and we are actually really proud to be associated with the Committee of International Taxation to have this event happen. Thanks to CA Prasad sir, CA Srinivasan sir, and Ashish, and CA Rishabh for having the panel discussion more active and relevant topic. And to be very honest, being there in the other side of the country, I must say, Srinivas sir and Prasad sir, your points were, to the apt to the, the relevance of the countries between both India and Oman. Ashish, he has given the exact picture of Oman as far as the investment or the tax perspective is concerned from Oman. And for Unmesh being the MC for the day, and also for all the audience who participated from across the globe. Thank you so much.
Thank you.
Thank you, everybody. Thank you, Sajid.
Okay. Just I have some requests so that continuity should be there in the efforts of the Oman and the tax community.
Maybe, sir, if you can turn your video off and keep the audio on, it probably think there's a bandwidth issue.
To the minute. Yeah. What you say that the issues which are there in the as well get news and we have a that we can go and where I can go and ask them that Oman, if you'll make these little changes.
I think, sir, we are losing you. We couldn't hear you for last almost a couple of seconds. I think we have lost Sanjay sir. So I would request all the participants, if they have any questions, they can connect to us on muscat@icai.org, or they can log on to ICAI-muscat.org website for any updates, any questions, or any information they would seek. Happy to support the fraternity. So thank you, everybody, for being patiently listening to the webinar. I formally close the session. Thank you.